Welcome back to Miller Momentum. Today we're going to ride the rough seas of the market with EDV and CAOS, two popular tail risk hedging ETFs. But how do they work under the hood? And which of the two do I prefer? Both target fast stock market crashes, but they do so in different ways. But before we dive into today's fund analysis, a quick disclaimer. I am not a financial advisor, and this is not financial advice. The content in this video is for entertainment and educational purposes only. Past performance is not indicative of future results. Statements made are my opinions. Investing involves risk, and always do your own research. Instead of a traditional fund deep dive, I want to work through a question I spent a lot of time on, and I want to be straight with you about where I landed. Long-term Treasury bonds versus tail risk options, specifically EDV and CAOS. Both are used as crash hedges. Both have serious supporters. And there's real debate about which one you'd actually want in your corner when the markets fall apart. I'm going to steelman CAOS first because it deserves a serious look. Then I'll explain why I still ultimately chose EDV after holding CAOS for years. And more importantly, why I think the case against bonds is often overstated. This isn't a takedown of CAOS. I want to be clear. CAOS is a really good fund with a lot going in its favor. Today we're doing a comparison though, and I do think that EDV comes out on top. Let's get into it. I'll start by explaining what each of these ETFs actually is, because neither ETF is especially intuitive. EDV is the more straightforward one. It holds long-dated Treasury strips. That's zero-coupon Treasury bonds with maturities of 25 years or more. The fund has an effective duration of about 24 years. What that means in practice, every 1% drop in the 30-year Treasury yield produces roughly a 24% gain for EDV. It's mostly a pure expression of interest rate sensitivity. Vanguard runs it, there's no manager discretion, and it costs 6 basis points. You know exactly what you're getting with EDV. CAOS is more complex. The bulk of the fund, around 70 to 80%, sits in T-bills and/or box spreads, which just earn a market interest rate, roughly 5% right now. Though historically, the fund has directly held equities from time to time. The remaining 20 to 30% buys deep out-of-the-money put options on the S&P 500. These are options that only pay off if the market falls significantly. In a fast, violent crash, those puts become very valuable very quickly. In a calm market, the T-bill-like income roughly covers the cost of the puts, so the fund aims for near-zero drag in good years, or more recently, it's been aiming for bond-like returns. Short-term bond-like returns, that is. So you've got two very different mechanisms and two very different types of protection, both geared at fast crashes. That matters a lot for our analysis. Here are the three strongest arguments for CAOS. The first is, it's rate agnostic. EDV's protection depends on one specific mechanism. Rates have to fall when markets crash. Most of the time, that's exactly what happens. But if the crash is driven by fiscal panic, if bond investors are selling treasuries and equities at the same time, EDV doesn't help. April 2025 gave us a preview of what happens in that scenario. CAOS doesn't have that problem. The puts pay out based on equity prices, period. The second argument in CAOS's favor is carry. The T-bill-like collateral earns real money in today's environment. That's not nothing. And third, 2022. That's the single best argument for CAOS, I think, and it's a real one. When an inflationary slow bear market hit, EDV lost about 40% as a standalone instrument. CAOS was more defensive. The 2022 dynamics, persistent inflation, rising rates, no flight to quality, look more like where we are now than the 2008 scenario does. Of course, nobody really knows what's going to happen with the market. These are serious arguments. Don't dismiss them. But now let's look at the problem. And the problem is not a small one. CAOS is not the same fund it was the last time it delivered on its promise. The methodology has changed meaningfully, more than once. And the specific version that produced the COVID payoff everyone cites is not the version that existed for most of the 2020 to 2023 period. Let me walk through the history of CAOS because this is the part most people haven't dug into. I've categorized the fund into four distinct eras. Era 1, 2012 to 2013. When this fund launched as the Aaron Large Cap Theta Fund, it held actual stocks, US large cap equities with an options overlay on top, very different from what it is today. Era 2, roughly through early 2020, pre-June. There was a major structural overhaul during this time. The fund dropped the stock and moved to synthetic equity exposure via options. It introduced a defined protection ratio requiring out-of-the-money puts, and this is the version that produced the March 2020 payoff. It's the one that everyone points to as proof of concept. But there was also Era 3, June 2020 to January 2023. The put spreads were widened. This is the change that matters most for the analysis. A wider put spread means more of the crash protection is sold away to fund carry, which produces better carry in calm markets but a more muted response in a crash. This hidden era lasted about 2.5 years. The 2022 bear market happened inside this era. Era 4, January 2023 to now. The fund reverted to the tighter spread configuration from Era 2, likely to avoid retracing a similar path as in 2022 because with tighter put spreads, it wouldn't have lost as much as it did during that 2022 bear market. The ETF conversion happened in March 2023 during this reversion. The current CAOS should, in theory, work like March 2020 again. But keep in mind that's 4 distinct methodologies in 13 years. And it was just lucky that the COVID pandemic happened to occur during an era when the methodology was optimal to respond to it. And as I'll explain in a moment, the methodology of this fund can change again. First, though, let me deal with the COVID payoff directly, because it's the single most cited argument for CAOS. In March of 2020, the S&P 500 fell about 34% in 23 trading days. CAOS returned around positive 22%. That's real. The mechanism worked. The out-of-the-money put spiked exactly as designed. I'm not disputing the result. But I want you to think about this. That result happened under Era 2, the tighter spread configuration. 3 months later, in June of 2020, the methodology changed. The spreads were widened. That wider spread version ran for approximately 2.5 years, covering all of 2021 and all of 2022. Then, in January of 2023, the fund reverted to the tighter spreads. And I'm repeating all that because it's worth repeating. What if another crash had happened during that time frame? CAOS would have responded differently. So the test that's held up as proof of concept ran under a different implementation than what existed for the following 2.5 years. The fund you could have bought after March 2020, the one actually available to investors through 2021 and 2022, was a different instrument in a material way. Now, the current version, from January 2023 onwards, should work like March 2020, and I believe it probably would in a fast crash today. That's an honest read. But that brings me back to the fundamental question I raised about CAOS. When you're hedging against a market crash, you're buying long-term insurance. The whole point is that it's there when you need it, not just in the next crash, but in the crash after that and the one after that. CAOS has already changed its core mechanics 4 times. And crucially, the changes that matter most, the parameter adjustments, the strike selection, the spread ratios, the model's definition of what a fast crash even means, those can be updated any day without public notification or shareholder approval. Alpha Architect has continuous discretion over the quantitative mechanics involved. And that's not a criticism of the firm. They may have excellent reasons for every change they've made and every change they will make. But when I buy crash insurance, I want to know that the insurance policy I'm holding in 2035 has the same terms as the one I bought today. EDV cannot have this problem of changing constantly. Vanguard cannot decide to change EDV's duration, swap the underlying instrument, or adjust the strategy. The only thing you're exposed to is interest rate direction. You might be right or wrong about that, but at least you know what you're betting on. If you're nervous about the US government's fiscal reliability as a justification for avoiding long bonds, in my opinion, the solution probably isn't to trust a boutique manager's evolving proprietary model instead. That's trading one institutional risk for another. Now that we've talked a little bit about CAOS, let's make the positive case for EDV. And specifically, let's push back on the claims you probably hear constantly about bonds being finished. I know, bonds are dead, the 40-year bull market is over, deficits will keep rates high forever. These are real concerns, but they're often stated with more certainty than the evidence warrants, and they tend to come from people selling alternatives. Let me show you what the actual historical record looks like. There's 3 specific claims I want to push back on. First, the 40-year bull run is over, so bonds are useless. I don't agree. This confuses the absence of a tailwind with the absence of utility. The bond bull market ran because rates fell from around 15%, even 18%, to zero. They don't need to do that again for EDV to work as a hedge. Starting at 5% today, if a recession hits and the Fed cuts 200 basis points, EDV would roughly gain about 40 to 50%. There is significantly more room to the downside in rates now than there has been at any point since 2007. So the tailwind isn't all gone, and as interest rates rise, it becomes stronger going forward. The mechanism is very much intact. Second, fiscal deficits will keep rates elevated permanently. This is overstated. Japan has run debt to GDP ratios of over 200% for decades. I'm not saying that that's a good idea, I'm just saying it's a reality. The relationship between deficits and long-term rates is real, but it's not a one-way door. What matters for EDV is the direction of the 30-year yield in a crisis. And in a genuine deflationary recession, the Fed will cut. That's what they do. Third, bonds fail in the crashes that matter most. Again, this is simply wrong historically. The record over 60 plus years of fast deflationary crashes is nearly perfect for long treasuries. There are 2 genuine exceptions, though: March 2020 and April 2025. Both were unusual in specific ways that I'll discuss. Everything else, 1987, 1998, 2001, 2008, 2018, 2020 initially, produced a flight to quality in treasuries. Here's the historical pattern. Every major rate tightening cycle in modern history has been followed by significant gains for long duration treasuries. In 1982, after the Fed funds rate peaked at 18.9%, long treasury strips gained back 182% in a single year. Then 109% in 1985. Then 80% in 1986. 3 back-to-back extraordinary years following the rate peak. After the 2000 peak at 6.5%, Long bonds gained 42% as the dot-com crash hit and rates came down. After the 2006 to 2007 peak at 5.25%, long bonds gained 69% in 2008 as the financial crisis unfolded and the Fed cut aggressively. The Fed funds rate peaked at 5.33% in 2023. It began falling in late 2024. We are now in the early stages of a rate cut cycle that historically has been very good for long duration treasuries. I'm not making a prediction. I want to be clear about that. But I am saying that the structural setup, starting yield of 5+%, rate cut cycle underway, is historically the best environment for owning EDV, not the worst. This chart shows annual returns for long zero coupon treasuries, very similar to EDV, going back to 1962. The green bars are positive years, and the red bars are negative years. The big picture is striking. Yes, there are bad years, sometimes very bad years, like the 1970s as inflation rose, and 2022. But the peaks after rate tops are enormous. The 1982 bar is literally off the chart at plus 182%, then 109% in 1985, then 80% in 1986. What you see consistently is that the worst periods for long treasuries coincide with rising rates, the 1960s to 1980 on the left, and then 2021 to 2022 on the right, and the best periods tend to follow rate peaks. I want to be completely honest about the times long treasuries failed in a fast crash because there are two real exceptions and both deserve explanation. So first, March 2020. After the initial flight to quality, treasury prices reversed mid-month and sold off along equities. The mechanism was forced deleveraging. Hedge funds with leveraged basis trades received margin calls and had to sell whatever was most liquid, which was treasuries. This was a mechanical liquidity event. The Fed stepped in within days and bought treasuries at scale. Then the usual crash insurance kicked in. The negative correlation with equities restored itself quickly. Academic research concluded this was not a structural regime change. Now, April 2025 was a bit different. That was caused by tariffs, or rather their announcement. Here, the 30-year yield surged as equities fell simultaneously, the so-called Sell America dynamic. The tariffs were inflationary, which constrained the Fed's ability to cut aggressively, and the policy shock raised genuine questions about U.S. fiscal credibility and foreign demand for treasuries. This one is the more serious exception. If a crash is specifically about declining confidence in U.S. fiscal institutions, EDV might not be your friend after all. But here's the honest framing. The April 2025 scenario is also exactly when CAOS might struggle operationally in the future, even though it didn't this time. Options markets can behave unpredictably in genuine systemic stress, and a fiscal credibility crisis would put pressure on every financial instrument, not just bonds. So CAOS isn't necessarily a safe haven in that event. And really, saying that EDV failed in 2020 is misreading the situation, because you can see here on the historical returns chart, EDV very much did cushion that crash around COVID. And you can see that CAOS actually dipped as well during that period of mechanical liquidity crisis. And because, like I said, options can be put under strain by the very same pressures that can put EDV under strain. But if you went with EDV, you would have gotten a just as effective hedge against the March 2020 crash at a much lower cost, and you'd also have a strategy that can work during normal rate cut cycles and not only during fast crashes. So there's an argument to be made for EDV being much more versatile. However, if we extend our window of reference up to 2026, we have to be honest, EDV has not had a good decade plus. CAOS returned 3.43% over 2013 to 2026. On the other hand, EDV returned about 1.06%. So CAOS's max drawdown was 26% and EDV's was nearly 60%. The ulcer index, which measures the depth and duration of pain, and literally how likely an investor might be to develop an ulcer from watching their investments go up and down, was 9 for CAOS and 30 for EDV. The 36-month win rate for EDV was 56%, and that's barely better than a coin flip. These are real numbers from a real historical run, and they do favor CAOS convincingly. But there's one number on that table that tells you why I still chose EDV. It's the beta to equities. CAOS's beta is 0.1, slightly positively correlated with stocks in normal markets. EDV's beta is negative 0.19. That negative sign is the entire point. EDV actively offsets equity risk. When stocks fall, EDV tends to rise, not just sit there. CAOS is more of a crisis option that provides convexity in extreme periods, but it doesn't provide the same day-to-day negative correlation. And critically, this entire backtest period, this entire historical window, was one of the most hostile possible environments for long treasuries. 2013 to 2026 includes the taper tantrum of 2013, the 2022 rate shock, and years of near zero rates with nowhere to go up from. If you ran this comparison from a rate peak in 1980, on the other hand, the EDV column would look very different. It's important to put the historical numbers in proper context because the raw table understates EDV's portfolio value and overstates CAOS. First of all, you're going to see me refer to CAOS as CAOSsim, and that's because it's a simulated backtest of the current methodology more or less. Since CAOS has changed methodologies frequently, it's hard to get an apples to apples comparison here. Anyway, neither instrument is designed to be held alone. No one is running a 100% EDV portfolio, or at least I certainly hope they aren't. The standalone metrics tell you about volatility and character, but not real-world utility as a 10 to 20% allocation within a well-diversified portfolio. Second, the negative beta on EDV is the number that matters for portfolio construction. Negative 0.19 means that when equities fall, EDV tends to rise. That's the rarest property in a portfolio. Genuine negative correlation with risk assets. CAOS's 0.1 beta means it sits roughly independently of stocks in normal conditions, with crisis payoffs only in extreme events. These serve different roles. Third, the test period was historically extreme for EDV, as I've mentioned. Starting in 2013, which was a bad year for bonds. I called it the taper tantrum. Google it, look it up. It's really good reading. Anyway, after that, it suffered through zero rates. And then it suffered through the fastest hiking cycle in 40 years, through the ongoing fiscal environment. And if you ran this backtest starting from 1980, again, I have to emphasize the picture would almost certainly be completely reversed. Starting conditions matter enormously for any duration instrument. So, the takeaway is CAOS looks better on most standalone metrics over this specific period. EDV provides a different kind of value though, negative correlation and structural clarity that the metrics don't fully capture here. Here's how I framed the choice for myself. EDV's risk is known and economic. The mechanism is fixed. Rates fall, prices rise, and it can't change. The risk is purely directional. Are you right or are you wrong about where the 30-year yield goes? Starting at 5% plus, you have the most rate cutting room in 17 years, and that's a real nice setup. CAOS's risk is implementation. The mechanism has changed 4 times in 13 years. The current version should work well in a fast crash, but the version in 2035 might look different. The manager has discretion to change the strike selection, the spread ratios, the definition of what a fast crash even means, and they can do that without telling you. So here's the question I couldn't get past. If one's concern is that US fiscal institutions are becoming less reliable, and that's why one wants something other than treasuries, is the answer really to trust a boutique manager's proprietary options model instead? I feel like that's taking on even more institutional risk. So, for most investors, people who aren't going to track quarterly prospectus filings and monitor changes in Alpha Architect's options implementation, EDV's transparency is a meaningful advantage. You can explain to yourself what you own, why you own it, and what conditions it responds to. With CAOS, you own a black box that has already changed 4 times and can change again without warning. So here's my verdict. I think EDV is the more defensible choice for most investors, and I include myself in that group. I'll put my reasons again up on screen in summary. So right now we've got a starting yield of 5% plus, and that means maximum rate cutting room since 2007. So this is a great entry point in my opinion. The rate cut cycle has begun, and Vanguard's fixed mechanism means that what I buy today is what I own in 2035. In a well-diversified portfolio with managed futures and gold, the Sell America fiscal crash scenario is already substantially covered by the other instruments that I invest in. So I don't think that the concern about bonds is necessarily wrong. It's just not as clear cut as the marketing firms make it sound. To conclude, I think 3 questions should guide any decision about a crash hedge. First, know what you own. What is the instrument actually holding, and what does it respond to? Know why you own it. What specific scenario are you trying to hedge against, and does that scenario fit your actual risk exposure? And know what changes it. Can the instrument drift from what you bought? If so, how would you know, and what would you do? For CAOS, it's a serious instrument. The mechanism is real, the March 2020 payoff was real, the current version, with tighter spreads since January 2023, should work in a fast crash. But it has changed 4 times, and it can change again without telling you. And the version you buy today might not be the version you need in 2035. For EDV, on the other hand, it's a volatile instrument. The standalone backtest looks poor over this specific period. The fiscal concerns about long treasuries are legitimate, but the mechanism is fixed. The starting yield is the best in 17 years, the rate cut cycle is underway, and Vanguard is never going to change what it holds in this fund. Bonds are dead is a better headline than it is an investment thesis. So my choice is EDV. Your choice might be different, and that's fine. But whatever you choose, make sure you know why you're making that decision. Thanks for watching Miller Momentum. If this was useful, hit that like button and subscribe, and be sure to drop a comment. Do you own EDV, CAOS, both, or neither? I'm curious where people land on this one.